Thanks for watching this video concerning Openstax Chapter 20, Principles of Finance, Risk Management, and the Financial Manager. Be sure to like and subscribe for more content. What is risk? The financial manager maximizes the value of the firm for the shareholders of the company by minimizing risk and risk exposure. The financial manager focuses on three major areas: size, timing, and riskiness of the cash flows into and out from the company. Increase cash in, minimize cash out. Accelerate cash in, delay cash out. Our focus here will be on minimizing the risk of cash in and out. Companies normally encounter risk in the normal course of their business. Most companies prefer to mitigate risk in order to maximize cash flows. This is known as hedging. Other parties or institutions seek to take on risk in order to make profits. These are speculators. Since risk can be estimated and priced by both hedgers and speculators, markets exist for the transfer of risk from hedgers to speculators. Commodity risk hedging methods include long-term contracts. A firm enters into a long-term contract with a supplier, vertical integration, which involves the merger of a company and a supplier, and future contracts, or an agreement to buy or sell an asset on some future date at a price determined today. Foreign exchange rate is the quantity of one currency in terms of a second currency expressed as a ratio. The rate can be expressed in terms of either currency. This figure demonstrates Brazilian reals to $1 US. Note that the exchange rate can also be expressed as US dollars to 1 Brazilian real. If you know the price of a dollar in 5.4377 Brazilian reals, or reais, you can find the price of a Brazilian real in US dollars. This is done by calculating the reciprocal of the exchange rate. In this way, you can move back and forth between exchange rate quotation methods. USD1 equals BRL 5.4377. So USD1 over 5.4377 equals BRL 5.4377 over 5.4377. Cross multiplying and solving would yield that USD 0.1839 equals BRL1. The foreign exchange rate changes in response to many market factors. Underlying them all is the demand for and supply of the currency. When it takes fewer of the buying currency to acquire the bought currency, the buying currency has appreciated. When it takes more of the buying currency to acquire the bought currency, the buying currency is depreciated. If the exchange rate was USD1 equals BRL4, but moved to USD1 equals BRL5, then the US dollar has appreciated, whereas the BRL is depreciated. Transaction risk is the value of a business's expected receipts or expenses changes as a result of a change in currency exchange rates. This means the actual cash flows to or from the company are impacted. When cash flows are impacted, the value of the firm is impacted. Translation risk is accounting risk. A company must convert the financial statements of its international subsidiaries and affiliates into US dollars. If exchange rates change, the value of these affiliates will change too. Economic risk is a change in exchange rates impacting a business's number of customers or its sales. A company not involved in international transactions can face this risk. This risk may impact cash flows, but in a more general way. Companies may choose to hedge or reduce their currency risk exposure. Hedging takes several forms. A natural hedge is a business can offset its risk through its own operations. For example, a U.S. company may offset the collection of a pound sterling receivable against a pound sterling payable. Futures, like commodity futures, foreign exchange futures enable the user to buy or sell a specified quantity of a currency on or before the specified date in the future. Forwards are a contract between two parties to exchange a specified amount of currencies at a future date. For example, a company may purchase a pound sterling futures contract today, enabling it to receive the Great British Pound at a specified date. Options are instruments that give the owner the right, but not the obligation, to purchase or sell an asset for a specified price at some future date. Calls are a right to buy or an obligation to sell. The buyer or owner has the right to buy, and the seller or writer has the obligation to sell. The buyer or owner have the rights. Put is a right to sell for the owner, and for the seller is an obligation to buy. Sellers are obliged. We also have puts, calls, strikes, or exercise prices, spot rates, American option, and European option. American options can be exercised anytime. European options can be exercised only at expiration. Strike or exercise price is the price at which the option becomes valuable, such that it can be exercised. The spot rate is the rate today. Forward rate would be a rate in the future. The buyer of a call has a right to buy the price of the underlying when it rises. Maximum profits unlimited. Price of the underlying falls, and you can lose your premium paid. The seller of a call is obliged to sell. The price of the underlying falls, premiums received. but if the price of the underlying rises, they can have unlimited loss. A buyer of a put has a right to sell. The price of the underlying falls, and the strike price minus the premium is their profit. The price of the underlying rises, you lose your premium. The seller of a put is obliged to buy. The price of the underlying rises, they receive the premium. But if the price of the underlying falls, the strike price minus the premium is their loss. The volatility of interest rates can lead to uncertain cash flows. In the case of bonds, changing market interest rates will yield changing bond prices. The relationship between market interest rates, which impact yields to maturity, and bond prices is inverse. Market interest rate changes directly change bond prices, resulting in interest rate risk. The IRS allows companies to borrow in their market of comparative advantage and convert those debt service obligations into their preferred profile, all the while saving interest costs. This is why you would use an interest rate swap, as demonstrated here. So for example, payments and receipts, -5 plus 5.5 LIBOR. The net amount is 0.5 minus LIBOR, and the benefit is 0.75 in this example if LIBOR is -0.25. Negative LIBOR plus 0.75, parentheses, minus 5.5 plus LIBOR, the net amount is -6.25, so the benefit would be 0.5 in that particular case. So here you see what would occur is alpha or triple A would give LIBOR to a bank in exchange for 5.5%, and investors would receive 5%. So alpha would get the 0.5 benefit there. With beta, triple B, they pay lenders LIBOR plus 0.75. The bank gives them LIBOR, which helps them pay with the lenders, and in exchange, beta pays 5.5%.